Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 7th of June, and we have Brent crude oil trading in Asia today just shy of $80 a barrel at the moment, popping, knocking on the door of 80 and then dropping back a little bit. But ultimately, 80 on Brent, and that's a recovery, it appears, through the course of the week. As the rate easing cycle has begun, Canada and now Europe, ECB, both cutting 25 basis points. Paul Hicken, editor-in-chief, petroleum economist. We've now had the whole trading week to digest OPEC Plus's meeting and decisions on Sunday. Where do you think it all lands as we close out the week?
Yeah, thanks, Sean. Basically, the OPEC Plus meeting it's been digested quite a lot by everyone, but it gave a bit for everyone. There was things bearish, there was things bullish. You can read it all sorts of ways. You take, for example, the poll you did on the voluntary cuts from the OPEC 8, and on one level you could see you could argue that the extension just for one quarter is bearish, that you're going to see supply coming back. But on the same token, you could argue that there's optimism that will be supply tightness in those 3 months, and OPEC felt justified to open the door to that. So you can read in a market whichever way you want to, but there was enough in there. But what was key was it didn't really alter the ultimate fundamentals in the market, which was a bearish trend right now. We've Like you were talking about at the start of the show here, it's the macroeconomic indicators have not been supportive out of China. You've seen factory output data showing slight contraction again. That's unconvincing, and the market, at least at the start of the week, it needs, and probably still does need, more convincing about the change in the rate cycles from the US, especially. Yes, we've seen it with the ECB and Canada and a few other countries as well, but US is the one everyone's watching. And non-farm payrolls today will be key, will be another one to look at. But that's the cycle that everyone's looking at, and there's still a lot of uncertainty, and the market's going to need a little bit more convincing before it really shakes out of its bearish trend. And no matter what OPEC really did at this meeting, it wasn't going to really change that unless it did something drastic, which obviously it wasn't going to do.
Yuri Humber, founder and president of Japan NRG platform for the Yuri Group. Yuri, all things from a supply side, as Paul just articulated, as OPEC continues to manage that part of the equation. The demand side, obviously, is the greater unknown. It's the piece of string. You just don't know how long it is, and you're constantly trying to pull at it. But the key area, of course, is Asia, and Japan, obviously amongst the biggest economies in Asia, next door to China. What's the outlook there, do you think, for the second half of the year, the tightness that Paul talks about in terms of demand picking up, the health of Asia and the biggest economies in Asia, Japan being one of them? Your thoughts on that for the second half?
Thanks very much, Sean. Well, as Paul mentioned, I think that, let's say, Chinese demand is a little bit of an unknown because there hasn't been a strong uptick in purchases, although there are signs of maybe some recovery in LNG, a slightly bullish trend emerging in that. But Japan, which is still among the top 5 oil importers in the world, I would say is actually contrary, is a little bit on a counter cycle to a lot of what's going on in Europe and North America, at least on the rate side. And that's a good thing if you're talking about demand side interest, because Japan has had to contend with a really weak yen, especially for the last 6 months. So if you think about it, on a kind of a numbers basis, the yen is about 12% weaker today than it was 12 months ago. That means that Japan's, purchasing power.
That's all? 12%? I mean, it's gone from about 100 something to 160 on the dollar. How is that 12%? What's the calculation there?
Well, for May, it averaged at 156 yen to the dollar. It is at about 155 today. And I don't have the exact number for May 2023, but yeah,
It's
a
only
12%.
12%, basically. I thought it was much
Well,
more
the
than
trend
that.
over the last if you want to go back 3 years ago, then yes, it's a massive change. And, really, say 3-4 years ago, we were talking about 120 yen to the dollar. So
Okay,
that,
so the big move is in the last year. It's already been a year. Yeah. Okay.
Exactly. So this somewhat normalized, but of course it's had a massive impact on the economy. I mean, 2022 was the worst shock. In 2022, Japan actually paid a quarter of Japan's imports were fossil fuels, right? So that is a massive amount of money. And what's more important from a Japan perspective is that it was paying more to import fuel than it was actually earning from export of electronics, machinery, cars, and so on. So, of course, this isn't a sustainable cycle from an economic perspective. And only now has the economy been able to somewhat digest it and get somewhat stabilized at the current level. So,
But just to pick up on that, Yuri, before you go on, you just mentioned earlier is the idea that somehow Japan had no role in this devaluation. I mean, is that an interpretation of what you're saying? I mean, it seems to me they've chosen this devaluation as an effort in order to sort of once and for all get out of the stagflation they've been in. But where's your sense of choosing this path to
I've heard
import
people
inflation?
look at it that way. I don't think that's the case. Japan's interest rates are counter-cyclical to the US ones, right? So as inflation and as the central banks in the US and Europe have raised the interest rates, Japan's Bank of Japan was essentially at negative interest rates until a few months ago. So the fact that the rates everywhere in the world were going up, and the fact that Japanese interest rates were frozen meant that the yen weakened, right? So you could argue that Japan is responsible for that, but as we know, that the central bank is an independent body. So I think it would be very hard to pin this one on the government. It is a factor of a much.
They obviously haven't taken any strong action to counter it. They haven't raised rates. They haven't made any attempt to sort of counter the devaluation of the yen.
Well, they have. But first of all, as I said, rates are the remit of the central bank, and that's not something that the government has direct control over.
Right.
Second, the government has intervened in the currency markets recently, spent quite a large amount of money in May, an incredible amount of money trying to shore up the yen and stop it from weakening further. But as you know, going against the flow in the FX markets is extremely expensive and basically a lost cause, given the size of the markets. So, and anything that Japan does in a very overt way would be, quite rightly called out by other countries, right? Any kind of currency manipulation is obviously seen as bad either way, whether you're trying to weaken or strengthen the currency. So if you're referring to maybe what happened, let's say sort of 5-10 years ago, when Japan definitely used its government policies to try and weaken the yen from where it was like the 75-80 yen to the dollar level, then yes, that we can definitely agree on that. But in terms of the yen going from 120 to 150 to 155, I really don't think that was part of the plan. It has given Japan some positives, such as manufacturing now seen as more attractive to do in Japan, for sure. But as I mentioned earlier, if you're spending a quarter of your import money just on fuel, and you're not making enough from exports of your manufacturing, then that's not really a good deal.
No, thank you for that. It's not often we get a voice from the ground in Japan, and it's great to have that sort of macro overview. I'd like to welcome Max Torres, who has successfully managed his battle with Zoom this morning.
Yes, guys, sorry.
Managing partner, of course, of Plata Energy. Max, I wanted to get some insights from you because, of course, the big OPEC decision this week, a lot of the focus, I mean, they made a number of decisions, but one of them was around the idea of bringing back some of their cuts starting in October. And I wanted to understand from you, where are the Americas at in terms of adding supply this year? Because, of course, that could spoil the party and has in the past, shale and other places. Now we've got Guyana and so forth. Where are the Americas in the adding of production capacity this year that could maybe delay the plan Saudi that OPEC Plus has for raising production in the fourth quarter?
Thank you, Sean. I'm sorry for the delay. I was having issues with the Zoom. Yeah. So again, thank you for having me. Yes, good question. Well, first of all, U.S. now is the superpower in the Americas. I mean, they are producing 13 million barrels. I mean, they are producing more than the Russians, more than the Saudis. So basically, they are, the superpower of oil and gas in the world now. So they may have some extra capacity left, but again, they are 13 million barrels per day. Elsewhere, I think we can see some increases in Brazil. We'll definitely see increases in Guyana. Suriname is sanctioned some new projects with Total. And my bet here is going to be probably Venezuela. We're going to have elections in July. We are going to have elections in the US in November. And my gut feeling here is that we are going to see some increases in the next years. Mexico just had elections, this past weekend. Nothing new there, so I'm not expecting nothing new. No changes in Mexico. Same party, same policies, so no changes in Mexico. So my guess again is that we're going to see, definite increase in Guyana and Suriname. We are going to see probably some increases in Venezuela, and I think the U.S., going strong again. They're record highs, more than 13 million barrels per day.
Paul, yesterday we had the big meeting in St. Petersburg. St. Petersburg's Economic Forum, and the Saudi energy minister, amongst others, was there. And he was pushing back quite strongly against the narrative that emerged earlier this week in the aftermath of the OPEC Plus meetings and their decision making, that was that OPEC Plus were moving moving towards a market share fight rather than a maximized price strategy, or a balance the market strategy, as they might call it. But your thoughts on where this goes from that point of view, the idea that the Americas are always bringing crude, they can bring more on, the price is right. We saw them do it obviously spectacularly 10 years ago during the sort of first big wave of the shale revolution. Where does OPEC Plus have to watch out for here, whether it's a strategy or not? But they're the ones carrying the weight of this market opportunity for all the non-OPEC Plus actors.
Yeah, Sean, it was a source of irritation, it seemed, and it's across the bear that OPEC has. It always has been. If it wants to raise prices, it incentivizes other producers. Now, the question really is, I think the fact that they've had to take these extra cuts, these voluntary cuts on top, meant it's a much more painful cross to bear than it was maybe in the past, and that's probably where the kind of chagrin has come from. Now, you'd think that it is a bit of a Sisyphean task for OPEC Plus right now, with the producers coming on from the Americas, like Max has mentioned. In a way, it was harder pre-COVID, when you had the shale was much more owned by independents. They were much more responsive to prices. They provided much more of a ceiling to price than shale and US production now. And there's probably less room for growth in the same way, arguably, than maybe a few years ago. But at the same time, it just shows how much OPEC Plus has had to go the extra mile to get prices at a level that it's comfortable with, whether you call the floor probably last year we were talking a floor of $70 a barrel. The goal's probably shifted towards $80 a barrel. It's being tested right now, and that's where you're probably seeing the kind of irritation. I think that irritation will probably subside over the summer months. You've got seasonal spikes in demand from the summer driving season, crude burn, these kind of factors, which will probably tighten the market over the next 3 months. But in the meantime, probably OPEC Plus doesn't really want to show the same patience as it has in the past, even though it is playing a longer game. You see that with its forward guidance. It's done a lot of good things in that meeting to bring unity, to show transparency.
I mean, it is phenomenal the amount of things they actually agreed in that. I mean, obviously they didn't all agree it on Sunday morning, but that the announcement on Sunday, but the scale of the amount of pieces that they found agreement on, that you would have thought, and that would have been a more difficult journey for them.
Yes, for sure. And yeah, some things were kicked down the road, you've got to say. Baselines has still been, the fact that Angola left at the start of the year, and there's the African producers, certain other countries, baselines has been kicked further along the road because probably because of the complexity of the meeting, because so much had to be done to try and get the market to continue this stability they're trying to achieve, which they have achieved, and it was an incredible achievement, and that's probably why also there's that irritation, because it feels like, well, some of the way the media have written about the deal and the bearishness probably thought, well, look at what we've done, and they've kicked things down the road in the past. The UAE was a source of contention a year ago, and that was kicked down the road. The UAE sucked up a lot to get to this point, and they were rewarded for that. And hopefully that's also, they're probably thinking that's a sign to other members that you stick with us now, you'll get your rewards a bit further down the line. And the sound.
But I think when you add it all in, it's Friday, the last trading day of the week. This is a sort of monster meeting on Sunday, or a monster announcement on Sunday, taken a few days for all of the sort of talking heads and everything to digest, all the banks, all the analysts, and you end the week at $80 Brent. I think you would think from an OPEC Plus producer point of view, that's not a bad outcome after all the washing machines have been churning for the last week and sort of digesting all this stuff. That seems like a positive place to be going into the weekend. Let's go back to Japan, Yuri, because I wanted to get a sense of where we are with LNG and where we are with power. We're already seeing, and we're probably going to see similar in Europe, which could be another demand surge with the heat this summer seems to be delivering. We're already seeing major heat numbers in India, reports of 50 degrees already. Yuri, where is Asia at? Japan, of course, the most advanced infrastructure economy in Asia amongst them. Where's Asia at to handle this surge, and what's it likely to have for access to the LNG it needs? Did we lose Yuri? No, there he is, but he's on mute. He's on mute.
Sorry, apologies. Yeah, back.
Yep, please.
On the LNG front, I think things are looking a lot more positive for Japan, or potentially even for LNG sellers than they were, let's say, 2-3 years ago. There is a couple of reasons. One is on the policy side. So 3 years ago, Japan passed its latest edition of the Strategic Energy Plan, which really cut the share of LNG by 2030. Sort of strategically, said that the share of LNG in the power mix would drop by half to about 20%. Now, obviously, that's a very negative signal for long-term contract purchasing and so on. And that was part of the decarbonization sort of moves, etc. However, was at an energy conference this week in Tokyo, and there were a lot of executives from the gas sector there, from the Japanese buyers, also from the suppliers, and the mood was very, very different. I think there is a sense that with the renewable capacity rollout having kind of slowed down a lot for various factors, and nuclear not having ramped up as quickly as the government might have liked, the LNG actually is the most realistic sort of player to play that sort of balancing role in the grid. So what the LNG buyers in Japan are saying is, look, the government has to update the energy plan, which it's actually in the middle of doing and probably will publish by the, well, they've promised to publish it before March 2025. So the next edition, they say, is going to have a much stronger LNG share. And that gives confidence to the buyers in Japan to then go out and buy long-term contracts. But the other, I think, bullish factor from an LNG perspective is that if you could sort of in the past, you could probably sort of predict Japanese demand based on long-term contracts, which used to make up, 85%, 90% of total. But actually, some of the major buyers are now starting to get more comfortable with buying midterm and short-term and spot cargoes because of the volatility, because of the temperature changes, and the much greater difference between demand in the peak seasons, as you mentioned, the summer coming up, the hot weather, and the shoulder seasons. So actually, we had a buyer like Tokyo Gas, one of the biggest buyers, of course, here, saying, we are moving towards a 40-50% spot purchases, which, was a huge surprise given how much this kind of long-term utility type business used to behave. So I think we will see a bit of a resurgence over the summer months, and probably you'll start soon because, as you know, we've got to tie up the contracts before the real heat in August comes in.
Max, I wanted to get your thoughts on, obviously, the big news of the week in your area is the election in Mexico, the election of Claudia Sheinbaum Pardo, who is the first female president of Mexico, a very left of center politician. Obviously, that comes a few months after in Argentina, the election of Javier Milei. But starting with the Mexican, what is that likely? Pemex has been struggling in recent years to find progress. Will this open up some growth, some development for Pemex?
I'm pessimistic about Mexico's, outlook and future. As you said, Pemex is struggling. Pemex has a very large, huge debt. We are not seeing good numbers as far as production is concerned. We have seen large operators, leaving the country and resigning, blocks. So essentially, I'm not really, bullish about what's going to happen in Mexico in oil and gas. The economy in Mexico is strong, in other sectors, but I don't see growth in Mexico as far as production and new players and new investors. I think we're going to see some, local companies, some medium, small companies, taking over, some projects. Some of the established players like Bridas or Repsol, keeping pace, their own projects, offshore projects. But to be honest, I'm not really, bullish about what's going to happen in Mexico with the new government. It's going to be more of the same, and unfortunately, the last administration was not very supportive of, business environment.
And she is essentially a student of the former president.
Right. She's a protege of, the former president. So we're going to see more of the same, unfortunately. In my view, of course.
Let's go to the survey question, which is sort of the key North Star. Brent crude oil price will likely average about $83 for the first half. We're so far into the first 6 months of the year that the landing place seems to be $83, or give or take an average for the first half. My question this morning is, what will average be for the second half? What will the average for Brent crude oil be for the second half of the year? Will it be higher than the first half, lower, or same, more or less? We've sort of hit Brent's sweet spot from Manny's point of view. That's comfortable spot for producers, comfortable spot for consumers. As Paul pointed out, more or less the sort of floor target really for the OPEC Plus appears to be in the low 80s. So they're happy, one would think, if they can hold this number. They've had a successful first half in doing so. Will that be higher? We've got tightness coming in the second half, as pointed out by most forecasts, most commentators. The natural cycle of the annual demand year gets higher in the second half. So all in all, Brent crude oil averaging about 83 in the first half. What will it average for the second half? Higher than that? Lower? Same, more or less? Paul, looking at the decisions that have to come into play vis-a-vis the new supply that we've been talking about, the sort of non-OPEC plus. The fact that OPEC Plus are the 8 countries that are part of the OPEC Plus and that are holders of these additional output cuts, voluntary output cuts, and they have presented on Sunday a map for the unraveling of those cuts. My question to you is, what impact do you think that will have on producers in the shale patch and Guyana and in the non-OPEC plus universe who are thinking about putting some money in the ground? Oh, OPEC's bringing that volumes back. Will they hold? Will they get out in front of it? How do you think it impacts the wider industry? We're getting an unprecedented view on OPEC's next 18 months.
Well, you refrain from calling the Great Eight so far, the new colloquialism for them, but
I'll wait for the acronym. Acronym.
Yeah, like the OPEC Plus, yeah. But yeah, it's a good point. And I think there's probably, regardless of what they're going to bring on, because it's caveated in terms of market conditions, but
nonetheless, that's the roadmap ahead, all things being equal.
Yeah, but what it is creating is stability, and what OPEC really have been doing more than probably in the past. There seems to be a greater achievement of market stability, and that is good for investment. That is good for creating an environment for investment, and that's what OPEC Plus want. If you look at the IEA report recently, just the other day, talking about investment, and it's the NOCs, it's the Middle East, which are doing most of the investment in oil and gas upstream. There's been regardless of what we talk about the non-OPEC, it's actually that's where the upstream investment's really going at. Yes, there is the US. Yes, there's some decent pockets across the Americas for sure, and Africa. But who's going to be gaining most? It's the Middle East. It's the NOCs. They're the ones that really were going to be the last man standing in terms of the marginal barrel, and they are in for the long haul. And so regardless of the next year or two, I would argue while the oil market and some industry players are playing checkers, OPEC Plus are playing chess.
There's an analogy. Looking, Yuri, at the one of the things we talk a lot about this year is the geopolitical risk premium that has inflated at times the oil markets in particular, and then has deflated. And obviously we talk a lot about Israel's war in Gaza, Russia's war in the Ukraine. But there is increasingly tensions in Asia, in the South China Sea. We see tensions boiling up between the Philippines and China. We see North Korea shooting missiles across North Korea. China's military capabilities, ramping up all the time, quite significant. We saw some very strong words out of the Chinese defense minister in Singapore earlier this week, where they were commenting. There's a new government in Taiwan that is maintains a stronger kind of commitment to independence narrative. My question to you ultimately is, all of these things adding up to a greater geopolitical risk in the Asian theater that we don't really account for in the energy markets?
Yes, absolutely. I agree. I think that the difference is that the initial set of conditions or the events, if you like, that you mentioned are active theater sort of, ongoing um, and maybe happened fairly rapidly. Whereas some of the events in Asia have been going on for a very long time. So it's that sort of perfect boiling frog syndrome in the sense that when things take, with North Korea shooting missiles at or near Japan on a fairly regular basis, and clashes between Chinese fishermen boats and Coast Guards boats of the Philippines or Japan happening regularly, but on an ongoing basis, sometimes people sort of lose that sense of urgency. But I think that if you want to see how Japan is looking at it, then, very simply, the end of last year, for the first time since, the post-war period, Japan announced a very, very new looking defense strategy. It promised to essentially more or less double its defense spending, to 2% of the GDP. There's certainly a very great awareness of the need to improve on the defense capabilities, go further. There is great collaboration, therefore, with Europe that Japan is trying to do, as well as its American sort of defense pact. So clearly, there is that sort of thing, that risk bubbling up. There is also a constant conversation about the Taiwan risk, the Taiwan invasion risk, which, as you know, many commentators sort of put at around maybe 2027, 28. But I think that what probably will keep it from really appearing on everyone's radar is that kind of real trigger, that real skirmish that would maybe confirm it and put it into the market risk. At the moment, it's just something that people are aware of, but maybe not actually assigning much of a premium to.
Yes. So the survey result in this room, higher sort of spread, same more or less, getting most of the votes, but higher and same more or less is 90%. And I think most producers would be happy with that, but maybe not the consumers. Max, last word with you. I mean, one of the big sort of factors we talked earlier in the larger region of the Americas where additional supply would come from. The big acquisitions that Exxon and Oxy made in the shale basin in the US, picking up, buying some of the biggest players in the basin, but yet no real added supply this year. How should we interpret that? Will that eventually result in those acquisitions? Will they eventually result in greater supply, a much more accelerated supply from the basin? Your thoughts on the follow through now that those deals have been signed off? Pioneer was finally ratified in the last week or so. Where should we expect, do you think, these big acquisitions in the US shale patch to deliver for additional supply in the US?
Great question, Sean. I think fundamentally we're seeing a change in dynamics on M&A. Essentially, M&A capital has doubled. In the last 5 years, I think it was something like 240 billion. Compared to 120 billion in the 15 to 19. So essentially, we are seeing a consolidation wave, as you said. Exxon buying Pioneer. We are seeing Chevron buying Hess. We are seeing ConocoPhillips buying Marathon. So we are seeing a wave of M&A activity and across the world, especially in the US, of course. And essentially, this new wave of consolidation is in response to a concern from investors, as far as the valuation of the oil and gas industry and the companies. So the companies are responding to those concerns about, volatility, oil curve accommodation, and industry maturation. They are basically responding with more rigorous capital allocation, value return strategies. Essentially, they are being more careful and aware about how they allocate capital, to provide value to the investors. As far as more production, probably we will not see more reserves or more production. As I said, probably US still is going to increase the production a little bit, but this M&A activity is not designed towards the increase of production, but is more designed towards the valuation and increase value return for the shareholders. And so basically that is the dynamic that we are seeing in M&A in the US.
Okay, well, we're going to have to wrap it up there. Went a little over time as we didn't get Max joining us, so good to get his final words there. We close out with Brent crude oil, as we said at the top, just trading a little bit. Now it's popped over 80. If it closes out the week above 80, symbolically, if nothing else, I think everybody goes on their weekend smiling, at least from the producer side. Consumers always like a lower price rather than a higher one, but obviously everybody can be happy with 80, one would think, generally on the macroeconomic side. Thank you so much, as always. Great to have Paul Hicken joining us from London, Yuri Humber from Japan, and of course, Max Torres from the Americas. Great to have your insights this morning. Have a great weekend, everybody. We'll catch up to you next week, 10:30 UAE time each day. All the best. Thank you.
Thanks, Sean. Thanks all.
Thank
Cheers,
you, Sean.
guys.
Thank you. Bye. Cheers.